All right, joining us now to talk a little bit more about today's Fed decision, what it means for investors in the year ahead, is Jeff Klingelhofer, the head of investments at Thornburg Investment Management. So, Jeff, just your first impressions of what we heard from Powell today.
Yeah, it was really a mixed bag, right? So part of the commentary from Powell was a little bit hawkish in the sense that a lot of the uncertainties that they had seen within the global landscape were removed. And part of this is just tiring of the flip-flop rhetoric around trade. But the flip side is we saw the dot plot come down rather significantly. And the most interesting takeaway to me is that the Fed at this point doesn't see that they'll get back to neutral before ultimately they have to cut rates. That's just not in the cards this cycle. And to me, that's very concerning, a recognition of some of perhaps the excesses in the market and the late stage cycle that we're in today.
That said, are we focusing too much on the dot plot? I mean, Chair Powell himself said that none of us have much sense what the economy will be in 2021. We've already seen, look, hey, they raised rates and then things changed and then they decided to cut rates, and they can just make this up as they go along, right?
Well, they're forced to, right? I mean, they don't know what the future holds. And the reality is we're only 1 year away, or 1 year past, not that long ago, that Powell was talking about being a long way from neutral, and that was to the high side. And so I think the biggest mistake is perhaps, to your very point, the markets are focusing a little bit too much on the dot plot. I'm surprised by the reaction in the 10-year because we continue to see wages tick up. We had a very blockbuster job number just a few days prior, right? There is this lingering risk that inflation could return. Now, it wouldn't be my base case, but in the markets, we as investors are forced to focus on both sides. And so I think rates markets are a little bit too complacent that the Fed is on hold here.
All right, so what does that mean for investors, though, really? I mean, isn't it a good thing that the Fed didn't do anything unexpected? I mean, if you think about it, Jeff, right, raising rates means you're concerned we're overheating, cutting means we're not growing fast enough, so setting and forgetting, isn't that a positive for investors for 2020?
Well, you're exactly right. It is a positive, but only in the short term because things don't stay the same, right? And that's the biggest risk that I see to markets today is they assume that what is going on today will happen in perpetuity. And we've seen huge moves from the Fed themselves. And again, my biggest concern is the markets are overly complacent, that we're just in a stasis. But I think the question is absolutely correct. Do we get inflation or do we get recession? And both of those have real risks. But the market isn't pricing in either of those. Both are pretty negative for risk assets. But really what the Fed did today, effectively I might add, is a Goldilocks scenario that we're just on hold and that what we see today will continue to play out. But that's just not the reality that we're likely to face in 2020.
Well, so, Jeff, I think, the Fed's moves in 2019 pretty much determined where the market went, right? They got more dovish, stocks went up a lot. As we look to 2020, if the Fed assumes that they're going to be able to not have to react to anything, what do you see as the marginal driver of financial markets in the new year?
Well, so the challenge is looking backwards. What we've seen work in the stock market is a multiple re-rating, and that's exactly on the back of a relatively more dovish Fed. And I think those cards are just off the table. The Fed isn't likely to move in a more dovish direction from here unless they see a significant weakening in underlying economic growth. And so while I could see multiples staying flat at an elevated level, really we're going to have to see earnings growth come back into the picture. And that's going to really take a true fundamental shift on the underlying economic conditions. And I'm rather wary of that. So I continue to believe we're going to see strong bouts of volatility. And my belief is to play dividend paying stocks and just consistent income generation through fixed income is really the safest bet for 2020.
And when do you think this volatility is going to kick in? Because, I mean, we've had a couple little hints, but it's been relatively quiet, especially after last December.
It has been, and that's always a little bit of an eerie sign to me, just given the significant speed bumps that we have on the horizon, right? Anyone's best guess, ultimately, what happens to trade. It's day to day, whether we have a deal or we're close to a deal or we're still far away off and December 15th tariffs kick in. We still don't have an answer to Brexit. We still don't have answers to a lot of the underlying concerns that we've had for quite some time. And there have been bouts of volatility. Certainly late 2018 felt pretty terrible for investors. I'm not necessarily going to make a bold prediction in saying that late 2019 is going to feel the same way, but I am pretty convinced that we will see volatility likely in the first quarter of the year.
Hey, Jeff, I want to ask you about transparency and communication from Jay Powell. He's going to be speaking 8 times a year from now on. And that's great because we get to hear what's on his mind. and we have that transparency. But I think there maybe is some concern that there might be too much and that it can whipsaw investors. Where do you come off on that?
Ultimately, I think not only because of the amount of speaking, but I really think the Fed is committing a policy error here. And I think that the Fed is overly convinced that they have the tools today to actually prolong the economic cycle. And they view that as their goal today. And I don't think that is the Fed's ultimate objectives, right? They have three main objectives. So full employment, stable prices, and moderate long-term interest rates, whatever the heck that means. But I think they've been able to take that last piece and adapt it to some form of financial stability, which certainly is becoming part of their underlying mandate as well. And that's not necessarily always congruent with prolonging the recovery. So I think the more that Powell talks, they don't have a crystal ball, but maybe the markets are reading into it too much that they do have all the tools, they do have the crystal ball, and again, leading to complacency, which ultimately leads to volatility.
Jeff Klingelhofer, Thornburg Investment Management Head of Investments. Thank you so much for joining us on this Fed Day.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.